go forward. So the email that went out is talking about two things. One is our AFC happy hour coming up next Thursday, the 18th. And that is going to be on networking is the theme. We have an expert coming in. Expert is defined as somebody coming from more than 50 miles away. And she's coming from Florida. She's been a networking person all her life. And that's how she's found jobs, opportunities, sold things, and done things. It's also a lead-in. We have a new career services program director. He started about a week and a half ago. I included the job fair that's coming up on Wednesday, March 24th. That's going to be from 1 to 4 in the afternoon. It's going to be on through Handshake. And the link to that is also in the email that went out. So you have access to both of those activities. So for your attendance question for the day, hang on a second. If you could just put in AFC or fair or both or not sure. So just pop that in the chat and let me know if you can. And you had any questions on those activities coming up? Yes, I see the chat coming through. So thank you for that. It's good for professional activity credit. It's also good for extra credit in this class as of now. So AFC, maybe job fair. Cool. Appreciate the feedback. Appreciate the participation. And also mark your calendars for April 15th. Tax Day is going to be a career fair, a career night, alumni night. We're going to have more alums coming back. We'll have some alums coming back next week at 6 p.m. on Thursday, but we anticipate a whole bunch more coming back in April to share their insights. So, and if you don't get the email by midnight tonight, let me know, or this weekend, but again, I'll double check on what went out. The mailing should have gone through. All right. Other questions before we proceed on to talk more about receivables and talk more about Excel? Hearing nothing, I will go ahead and share my screen, and we'll go spend some time with Ben and Boz. Okay. So we're going to talk about some of the stuff we've already reviewed. We'll talk about FOB, free on board. We'll talk about sales discounts and terms. Those are all be a review. And then we're going to get into allowance for doubtful accounts, ADA, bad debt expense. What do we mean by net accounts receivable? So we got receivables that we expect to collect, and we never expect to collect 100% of what we bill. So we're going to have to record in the month or in the appropriate time period when we make the sale, stuff that we don't expect to collect. We're not going to wait 6 months or a year or 2 years to get the bankruptcy notice or to write it off when we realize 8 months from now, we're never going to get this money. So we want to write it off much sooner than that. So we have an allowance and we make some adjustments to take care of that. So I'm going to play this through and give you a chance to see in action all this receivable stuff going on.
Boz narrated PowerPoint series.
And actually, I'm going to do a new share, go to advanced, and get to the portion of the screen, and we're good to go.
I'm Boz.
I'm Ben.
How you doing today, man?
It is a great day. How are you?
You know, I'm excited because lessons 1 through 4 were the overview of financial
That's
accounting.
pretty cool stuff.
Yeah, but that was a kind of the framework, right? And now for these remaining lessons, we're going to just start digging into the details.
I thought the overview was great. The details are going to be even better.
Yeah, but you know, we've introduced sales to folks. We've introduced accounts receivable, but there's more there than what we've showed them so far. There is.
I can't wait to tell them about it.
Well, I tell you what, you're the leader today, so
I want to start with an example.
Do it, man.
Because I'm the leader.
You are. Go ahead and do it.
All right, let's do it. So first one, we're going to be looking at CVS Health, pharmacy, also some retail side of things.
And millions of them around.
I don't know about millions, but
CVS and Walgreens. You can't find a street corner without them.
They have had some big acquisitions lately with Target Pharmacy and things. But here we have an excerpt of their income statement. And Boz, what jumps out at you about this one?
That they have $185 billion worth of sales. I mean,
that's nothing to bat an eye at. Huh?
I told you they have millions of these things out there. So
you were looking at the revenue side.
I was.
Hey, that's a topic of today.
I always go straight to revenue.
But you know what? We got a bonus here too.
What is it?
Net revenue. Do you see that? You see that? Yeah. So what does that mean?
I think we're going to find out.
We are going to find out.
It's kind of implying that there's a gross and then there's maybe an adjustment before we get to
Gross
net
means
revenue.
like,
And we've talked some about that.
No, gross means undiscounted when we're talking about it in finance terms.
kind of like a total. There might be some things that reduce it. We call it net revenues. Cool. So we're going to be looking at that. And then the other side of revenue, we have accounts receivable. So,
Net.
Net. Oh, sorry.
Oh, sorry, I jumped the gun on
That's
you.
okay. That's okay. What I was going to point out is that we have net revenues of 185 billion and receivables are 13.1. So
Why does CVS even have, you pick this example, this is a bad example.
This
why
is an
does-
outstanding
Why does
example. I
CVS even
stand
have
by it.
receivables? I go there and I just pay in cash. And
well, we got to look at revenues for CVS and think
Okay.
about what are their revenue
they
streams.
sell stuff to me.
Like frozen pizzas, for
For
example.
cash, yeah. Sometimes I buy $100 worth of frozen pizzas
That's
at
a
a time
lot
there.
of frozen
So
pizza.
yeah, but I
They
pay
let you
cash.
return it?
Probably
we're
not,
gonna
but
get into
anyway.
that. So
Yeah.
anyway, so that'd be one side of their business. The other side of their business, do you ever get any prescriptions at CVS?
Yeah, and I pay cash for them.
You pay cash,
Yeah.
but do you ever get a statement from your insurance company saying how much those cost? So all
gotcha.
those insurance companies then reimburse CVS.
So they have
for those
receivables from
prescriptions.
insurance companies. So
It's
gotcha.
actually kind of a complicated revenue stream, but
Yeah,
we're not going to
that's
get into
true.
it a ton.
That's
But
true. Okay.
what we will get into, looking at accounts receivable, this is an excerpt from their 10K here down below, where they had a beginning balance of
10K?
286.
This
This
is-
is the allowance. So receivable is being reduced by 307. That's the net piece.
Okay.
And so they had a beginning balance of 286. They added some to it, subtracted something called bad debt expense and write-offs,
Yep.
which we're going to talk about today, actually.
This is the first time we've introduced them. So that down there is just kind of an allowance for doubtful accounts, kind of like an allowance for bad debts. Doesn't mean a whole lot to folks right now, but that 307 million is what they are kind of estimating. That's the portion of their receivables they might not collect.
Yeah, if you
So-
think 307 out of 13,000, well, that's not that big, but let's actually think about dollars. $307 million
dollars.
they're thinking they won't collect.
people aren't going to collect. Well, we better
Probably
teach
worth
them
it.
more about that too.
Yeah, we
So,
should.
but-
Probably worth their effort to try and collect it.
Totally.
All right, so a little bit of the overview. A couple of main goals here. We're going to learn about sales at a whole new level of depth. Specifically, learn about how do companies deal with credit cards, returns and allowances, and discounts. And then number two, we're going to learn about accounts receivable at a new level of depth. We're off on the timing. Let's stick to numbers.
We're off. So, yeah.
We'll get it back. Two new accounts that we're going to be using, bad debt expense and something called the allowance for doubtful accounts. And then we're also going to learn how do we estimate that allowance using percentage of credit sales and AR aging method. So don't worry if it doesn't make a ton of sense right now. Just kind of big picture, sales, accounts receivable, looking at new depth on there.
Stick with us.
All right. So first question was sales. Well, when do we actually record a sale?
I don't know, when we sell stuff.
Yes,
Right?
recorded when goods are delivered or
Recognition.
services are provided. Bringing in a couple technical terms early here. First one, well, for goods in transit, FOB shipping. And Boz, what does that mean? And what's the opposite of that?
FOB, free on board, right? So free on board
Woohoo,
shipping, free on board shipping or shipping point is sometimes referred to as. So basically that means that the ownership of the goods is going to change when it leaves the seller's dock. So when it leaves the seller's warehouse, that's when the buyer is going to take responsibility for those goods.
So like if CVS, if they were buying drugs from the manufacturer, as soon as those goods left the manufacturer, they would be CVS's. Even though CVS doesn't have it in the store, the ownership has transferred if it's FOB shipping.
Yeah, which is different than FOB destination. We did that one well. But yeah, an FOB destination, that is going to be when the goods actually reach their destination. So it's, it's simple. When I go buy something at CVS, I mean, it leaves them and it comes into my hand immediately, right? So I mean, the shipping point destination happens simultaneously. But to your example, if a supplier is selling something to CVS, those goods might be in a truck for a day or two, as an example. And if it's FOB shipping point, the revenue is recorded the moment that they leave that supplier's dock. If it's FOB destination, the revenue is not going to be recorded
be a good
until it
review.
reaches actually CVS's possession at that point in
Exactly.
time.
And so when we're talking about recognizing revenue, we're saying with the manufacturer, CVS won't recognize any revenue until they actually sell it, and they probably won't have much of a timing issue with just their businesses that they're in.
Sure.
So the question is, who really cares about the difference? Like, Boz, are we just talking about a day or two here with a truck delivering or driving across the country?
Usually, right?
Yeah.
So usually it either happens at the time, like when we're buying from CVS, or it's just a truck shipment, right? And it's probably not going to be more than a day or two. But especially with all the manufacturing that happens in China, as an example, I mean, they're not putting the heavy equipment on a plane or something like that and shipping it that way. They're putting it on a boat that can actually take a matter of weeks. So you can consider, what if a manufacturer gets done with some goods on December 20th, puts them on a boat, and it's going to take 3 weeks in order to get it to their customer, right? So that means that those goods will be just somewhere in the Pacific or Atlantic Ocean, basically at the end of the year. And
Whose goods are they?
well, yeah, and you go right back to if it's FOB shipping point, then they're the customer's goods, and if it's FOB destination, then it's the seller's goods at that point in time. So
Yes, and this brings up the liability idea. So what if there's a big storm in the ocean? Those are huge boats, and one of them tips. It's happened before in the past.
yeah, who's got to pay for the insurance? So
Exactly, and usually there is insurance that you're going to get when you're transporting those goods, just in case whoever's transporting it somehow crashes or loses them for you, you'll get it covered. So, although with CVS, interesting with prescription drugs, sometimes insurers will not cover that. Because it's so it'd be auto insurance in a truck, but it is so expensive for that truck with all the prescription drugs. You're talking $1,000 a pill sometimes.
Yeah,
that
yeah.
the auto insurer will refuse to cover that shipment. It's too expensive for them.
wow,
the risk.
okay.
Yeah.
They need good drivers then.
That was an actual
Not me.
scenario from a trucking company. They didn't want to do any more of those because they had a truck that crashed once. Anyway, we're drifting a little bit. So revenue recognition is a lot more complicated than we're talking about here, but that's some more of a topic for intermediate accounting. There's just been some new revenue recognition standards, and a lot of professionals are working with companies to help them figure out what to do over complicated contracts.
So when we say revenues recognized, when goods are delivered, services are provided, that's basic, it goes a lot deeper.
Exactly. All right. So let's jump into our first type of discount, looking at credit cards. And the first question is, why would a company even accept a credit card in the first place? Well, the big one is, Boz, do you carry a lot of cash with you?
Sometimes. So when you say a lot, I don't know how much you expect. So sometimes I got $100 on me, right?
Let me try and bring it down to maybe our audience is a little bit younger generation. And some of us in the younger generations don't carry any cash at all. It's all credit cards. So if a business doesn't accept a credit card, I can't pay them for anything. I'm not going to use it.
Not going to make that sale then.
Yeah, exactly. So bring in new customers because they accept that form of payment. And the good thing is that they receive cash right away. If they receive a credit card, they just tell the credit card company, hey, this, Boz had a cost or a transaction of $100, and they send it in, they get their cash that night or the next day usually. So they don't have to have credit risk waiting in case Boz doesn't pay me.
Yeah, so it's, as an example, so I've sold books before. As an example, I wrote a book, and if someone wants to make a credit card payment, they just give that to me within a day or two. I'm able to transfer that from my PayPal account, as an example, into my bank account, and then it's up to the credit card company to collect from that customer. And the customer might not pay them, right? There could be issues there, but that if the customer doesn't pay the credit card company, that does not impact me at all. Then the bank is on the hook for it and everything.
So the only downside here is that businesses are going to have to pay a fee to the credit card company for this service.
Yeah, totally.
Yeah, typically a 3%
All right, so the big question
fee,
is,
sometimes
why would a
2%.
business even want to do this? What's in it? So the big question is then,
You're too quick on that. I won't be able to edit that.
how about now? Hey, boss, edit it here.
Just give it a 2 second. You don't have to.
Okay. So the
Credit
big question
cards
is then,
because-
what do the credit cards gain from this type of setup? And the answer to that one is that businesses pay a fee for accepting the credit cards. And typically it's around 3% or so, but they have to record that. And that's going to be our first reduction to sales revenue and give us net sales revenue.
Exactly. When I sell a book for $15, I don't get $15. I get something. The credit card company takes their cut first. So
It's disappointing, isn't it?
it is. So, but at the same time, it helps me make that sale, which I otherwise might not be able to make.
Yeah, exactly. So let's see, what does this look like from the company standpoint? If a customer is going to pay with a credit card, the journal entry here, start with a debit to cash. And even though it's technically a receivable, most companies will just do cash because they're going to get the cash the next day anyway. Then they're going to debit something called credit card discounts. This is a contra revenue account. I don't think we've had one of these yet, have we, Boz?
Nope, not a contra revenue.
All right, so it's going to have a debit balance, and sales we know has a credit balance. It'll reduce the sales to give us net sales, and that's going to be then a credit to sales.
Yeah, so just to illustrate that, like if I sell a book and if I generate that sale through PayPal, to illustrate Ben's point, I would just debit cash right away, even though technically for about a day I can't get that money from PayPal. So maybe technically for a day I have a receivable from PayPal, but I can
Credit card
transfer
sales or
almost
cash
immediately. That's why
sales,
we just
that's
debit
right.
cash straight up.
So when you're bringing in $1 billion a day, around year end, that might be a big deal.
Yeah, that could be actually when I'm bringing in $1 billion a day. So we'll wait for that moment.
Well, let's move on and do a little bit more in-depth example here. So we have James. James is going to be our focal person today. He's purchasing $100 worth of supplies from CVS using his credit card, just general supplies for whatever he wants. And the card is going to charge CVS a 3% fee for each transaction. Usually it's around 3%. American Express a little bit higher, but that's negotiated between CVS and the credit card company. And the supplies cost CVS $50. So at the very initial journal entry, what we're going to do here is debit cash. We're CVS in this case. Debit cash for $97. Debit credit card discounts for $3. And we got that one by taking the $100 worth of supplies times the 3% fee. So
Good
we
math.
have. Thank you. I appreciate that. And then we're going to go ahead and credit sales for $100. There's more difficult math ones coming up. I'll let you handle
Nice.
that. And then, of course, we can't forget about cost of goods sold and inventory as well, the other half of any sort of journal entry when we're going to sell goods. All right, so that's it. There's no additional entry, anything like that. What we would show on our financial statements is net sales. And that's the idea of sales of $100. You see we recorded that right here. Less the discount of 3 gives us net sales. And most companies aren't actually going to disclose the dollar amount of the discounts just because it's kind of their own competitive advantage. Probably credit card companies won't like it, but they just say net sales is all they're going to show, the $97.
Yeah, they certainly have their financial systems that compute everything in the background and everything, but on the financials, oftentimes just net sales.
Yeah, and they're going to want to track this discount and all the other types of discounts that they give to help them with some better analysis. Ready to move on?
I am.
All right,
Got
let's talk about returns and allowances.
Companies don't like
This
these. It's
too.
sad.
It is
People buy
sad.
something from you and then they return it. They don't like it. They bought too much, something, right?
Something. There could be a few different ones,
Yeah.
but basically, yeah, customers just don't need it for whatever reason. And it is more common in certain industries. You added retail in here because customers think about right after Christmas, for example, people take things back all the time. Hardware and auto parts. I thought this was fascinating when I learned it. People would go to hardware stores and auto parts stores and buy like 4 or 5 different parts if they're not sure about the size.
Sure.
And auto parts store, they know about it. They're fine with it just because they get that one sale, but then they'll return the other ones.
It's kind of like me when I go buy 5 shirts and then I bring them home and I ask my wife, which 2 that I should keep because I can't make these decisions for myself.
It's a rough life, boss.
That's right.
It's a rough life.
Return the other 3.
All right, so when we have this returns and allowance, the selling company, what type of journal entries are they going to have? Do you want to take us through or you want me to?
I can do this one.
All right, I was on a roll, but that's fine. I'll share. That's okay.
You'll share.
Yeah, that's okay.
I like
okay.
it. So
all right.
yeah.
So
well, the goods are returned, so we need to. We're not going to debit sales when goods are returned. That's what you might think.
Contra
We actually
revenue.
debit a special account called sales,
Offset.
returns, and allowances, and it's so companies can track this separately. They want to know what they have for returns. And
I was going to
allowances.
ask you why, but you're on top of your game.
Well, yeah, I mean, I think it's just one of those. A company wants to track returns year over year, right? And if returns are really starting to go higher, that might be a cause for concern for the company.
And you could track returns too by a specific product as well.
Exactly.
And get an idea.
Yeah, and then credits to account receivable or cash, just basically however you sold it to someone up front.
Yeah,
You're
obviously,
gonna get
they're
that
not,
back.
yeah, they're not going to pay you anymore. So, and then
Yeah, but now you've got the inventory back, so now you debit the inventory. When you sold it, you credited it. So now you're just unwinding that transaction. When you sold it, you debited COGS, credited inventory, unwinding it, debiting inventory, crediting COGS.
so that's interesting. The sales side, we don't just go backwards and unwind it at all, but the inventory side we do.
Yeah, that's true.
And we can track it through that sales returns and allowances. That's the biggest reason for that. All right, so let's do a little bit more of an example. Here we're going to have two sets of entries: an initial purchase entry and a return entry. So we got James again purchasing $100 worth of supplies on account, and the supplies had a value to CVS of $50. That was their
I
cost.
think it's kind of boring to have them purchase supplies. I think it should have been $100 of frozen pizza.
You know, if only someone would have put that in the original version of the slides and
Yeah.
someone else didn't take it out, Boz.
That's true. That's true. Well, anyway.
Anyway, you didn't do that, did you?
No way,
Oh,
no
okay.
chance.
Okay. Well, we're going to go ahead and debit accounts receivable for $100. James is a frequent customer of CVS, and so he has a receivable account with them. And then CVS is going to go ahead and credit sales for $100. So debit accounts receivable, credit sales for $100. This should be a review at this point, right?
I hope so. Yeah, we taught them this one back in lesson 3.
Yeah, and then we've got to remove the inventory. So we're going to debit cost of goods sold, credit inventory. Boom, we're good. Initial purchase entry.
But then something sad happens.
Yeah, James
doesn't
realized-
need all the supplies. He brings them back.
Let's just say frozen pizza. He doesn't need $100 worth of frozen pizza. So, Boz, you want to take us through this example?
Yeah, that would be great. So just like on the previous slide, debit the sales returns for $70, credit the accounts receivable for $70, and then the math here actually is that it's 50% of the sales amount is what they paid for it. So half of that 70 is the 35. So that's the amount that we're putting back into inventory with a debit and cost of goods sold with a credit.
As long as we're talking about, original having frozen pizza. I also had more difficult math for Boz here because I know he can handle it, but we changed it to make it a little bit easier. So when we have this type of situation, net sales, what we're going to show is a credit to sales for $100 minus the returns and allowances of 70. So really net sales here is only $30.
True.
That's what would show up on our income statement, just that $30 amount for net sales. All right,
Yes,
one more example here on the sales side is with discounts. So what happens here is that a lot of times companies are going to provide discounts to entice customers to purchase more. And I'm not talking like just showing up at the store, 50% off, here's a coupon. Although that would have its own separate type of account. We're talking here more business to business type transactions where we're going to have a customer that does a lot of business with someone and say, okay, if you keep doing more, like a bulk discount, we'll give you a discount for that.
Yeah, well, what we're really getting into here is not a reduction in the sales price, but it's a reduction in the amount that you have to pay as a customer if you make payment more quickly.
Exactly. So it's another way of incentivizing customers to pay more quickly. And so one typical one that we see here is 210 net 30. That's how you would read this, 210 net 30. And what that means...
English? What even is that?
That is English.
Okay.
210 nets auf 30. That's be German.
That's great. So what
With a couple made up words in there.
What does 210 and 30 mean?
All right, so 210 means a 2% discount is provided if the customer pays within 10 days. Otherwise, you have to pay the full amount within 30. So
the
you
net
see, you
amount
get
within
that.
30
Do you think
days.
companies are, if say, yeah, a company gets this, do you think they're going to take advantage of the discount?
I think absolutely. If you can save 2% by making payment 20 days earlier, I mean, we could annualize that. That's like a 26%. I'll just round it off annual interest rate. That's huge. It's actually larger than that. I did the math wrong. But
Is it
anyway,
like 28%?
It's like 36%. Yeah.
Is it?
But yeah, it's
pretty good.
Yeah, it's high. It's high. It's a high interest.
It's high.
rate.
So basically, the gist of it, take the discount when you can.
Well worth taking.
All right. So what happens from the company standpoint? The company that is offering the discount here, when the customer takes advantage, you're going to debit sales discounts. Again, special account so you can track it. Make sure you know who is taking advantage of that. Debit cash because the customer's going to be paying for it, and then you're going to credit sales.
This one's a little tougher, so we'll definitely jump right to an example here.
Yeah,
to look at this one.
absolutely. So initial purchase entry, we got James again purchasing $100 worth of supplies.
We've been there.
And he gets terms 210 net 30. So the initial purchase entry, you said we've been there. Guess what? Nothing changes.
Nothing
It's the
changes.
exact same. What's a little bit different is now that James is deciding to take advantage of this and pay on day 9. A lot of companies will pay on day 10. Some will probably pay on day 13 and still try and take the discount. Actually,
And they won't get it.
they shouldn't get
Unless
it.
they can
But
sweet talk.
yeah, exactly. So what's going to be the journal entry at that point? Well, James is going to pay cash in 98. So CVS is going to debit cash for 98. They're going to debit the discount for $2. And the thing is here, they have to credit the entire accounts receivable amount of $100 because James isn't paying any more at this point. Even though he only gave 98, we have to get rid of the whole receivable.
The most common wrong way to think about this is someone would just debit cash for 98 and credit accounts receivable for 98. But if you did that, you'd be left with a $2 balance in the accounts receivable, and James doesn't owe you any more money, so that would be a problem. So that's a little tricky, but that's why
Something
you
to
got
watch out for. Hopefully, you're good at it now.
That's right.
And then so the next part, how would this actually show up on an income statement? Well, we'd have sales of $100 minus our discounts for $2, and that gives us net sales of 98. That is the number that you would see on the income statement then.
So a lot of different ways we can get from gross sales down to net sales.
Yeah, and a lot of different types of discounts
Yeah,
too.
absolutely. Credit card fees, returns, sales discounts, a lot of stuff.
Man,
I
sales
think we covered it.
Sales is fun, but I'm ready to move on to accounts receivable,
And bad
the
debt
allowance
expense.
for
This is the
doubtful
new stuff.
accounts. All right, so Boz, do all customers always pay their debts?
No.
I thought it was unfortunately no.
Too bad.
Unfortunately, no.
Unfortunately,
That's
no.
right.
It's just a fact of life. If you're doing whatever it was, $13 billion in receivables, and I guess I don't know how much of their revenue is that, there's going to be someone who's not going to be able to pay you. Just financial difficulties, things happen, you're not going to get all your money.
Yeah, usually people plan to pay you when they purchase from you. There's very few people that don't plan to do that. That's completely unethical.
And you're not going to
but-
make a sale to
yeah.
someone unless you expect to get paid on the way back. So
But a lot of people, buy stuff. They plan to be able to then resell it and make some money. But all of a sudden, things happen on their end. They can't resell the product, and now they can't pay back their supplier.
would you call this a fact of life?
It It is a fact of
It's
life.
a fact of
definitely.
life. All right. So a couple different methods. Boz here likes to explain this older method that nobody really uses. So go ahead, Boz.
I don't like to explain what it is. There's a method called the direct method.
Oh, sorry. Is that a little
where
harsh?
That's fine if it amuses you. Where a company, it might make sense if someone can't pay you that you would just debit a bad debt expense and credit an account receivable. All right. And that's where we're going to get to at the end of the day in the indirect method. But this might seem logical, but the problem with it is that this write-off, oftentimes you won't know that a customer is going to not pay you until maybe the year after you make the sale to them. So in that situation, you record the revenue in year one, the expense in year two, and it is not properly matched.
You're going to make me look bad in year two. Extra
Yeah,
expense
definitely.
that should have really reduced income in year one. So.
Yep, definitely. So that's why we are going to go to not using this one, and we're going to use the indirect method instead.
All right, and the indirect method is much more common. Some small businesses might use the direct method, or if they don't have a lot of experience, but indirect method is what a lot of your large companies are going to use, and that's where you reserve part of accounts receivable based on your estimate of not being able to collect them. And again, it's an estimate because you don't know who's not going to pay you. You just have to kind of make a guess at that time, and that's when you set up the allowance for doubtful accounts.
I mean, you don't know. I mean, if you did, you wouldn't sell to them, right?
Exactly,
but the point is, you're going to sell to a bunch of people, knowing that a couple aren't going to pay you. But that doesn't mean you're not going to sell to nobody, right? That wouldn't make sense. So, but I mean, you try to do some checks, you do credit check and so forth. But
and so then in that year that you're going to make the estimate, you're going to debit the allowance for doubtful accounts. That's a contra asset account. And sorry, you're going to credit the allowance for doubtful accounts, debit the bad debt expense. We have a contra asset and expense account, so you're matching the expense in the year that you recorded the revenue.
a couple of new accounts we're introducing to
Look
them
at
here.
that. Isn't that cool?
Yeah.
Like that graphic?
That's awesome. You did a great job.
It's
man.
smart art. I didn't do it.
Smart art. So.
All right, so let's go through an example, make this a little bit more tangible for you. Company has $100 of accounts receivable, and they estimate that $10 is not going to be collected. So the journal entry that they make at that time is going to be a debit to bad debt expense and a credit to allowance for doubtful accounts. And so remember, they're not giving up on any one specific customer at this time. They're just estimating of that $100,
We don't know who,
we're
we're
not
just
going to get
getting
10.
a
We don't know who
ballpark
it's going to be. We're just going to
expectations.
say it's about 10. So match the expense to the revenue. We're good in that year. And then they have an allowance, which again is a contra asset account. All right. So then what does that look like for accounts receivable on our financial statements? Well, we'd have gross accounts receivable, kind of like gross sales we talked about at the beginning, minus our allowance for doubtful accounts, because again, it's a contra asset, so it'll reduce that asset value. And that gives us our net accounts receivable of $90. That's what we're actually going to see in the financial statements. So last thing then, when the company does find a customer and they're not going to pay us, they give up on collecting. They don't just do this easily. It's going to be a while, but they're going to give up on collecting the $10.
And the logical thing might be you'd say, oh yeah, you're going to debit bad debt expense and credit account receivable, right? That's what you're thinking. But
we already debited bad debt expense up here, so we don't want to have double the expense. It doesn't make anyone happy. We're going to reduce this allowance and say we set this aside thoughtfully. There's no money that's actually being set aside, but we thought of setting something aside, and so now we're going to use up that allowance. So debit the allowance and credit accounts receivable.
Yeah, and that's like a perfect world right there. Where the first entry we had $10, the last entry we had $10. That's not reality. We just we did that to make it easy for this PowerPoint.
Probably another fact of life is that it's never going to be exactly.
Can't estimate
equal.
perfectly.
Yes.
So
All right. So the next question is then we got $10 in that previous example that we're not going to collect. Well, how did we actually come up with that amount? And every business is going to have to go ahead and estimate that amount that won't be collected. And it's going to be very different for different types of businesses. And they just usually use historical experience, their knowledge of customers to come up with the best estimate. But in general, there's two main methods: percentage of credit sales and the aging of accounts receivable. Boz, you have a preference on these two?
percentage of credit sales is easier. So,
It
but
is.
I mean, I suppose because of that, I actually like aging better, right? Just because it's more complex, a little bit more fun, a little
It
bit
is
more
a little bit
refined.
more-
So,
hey, it's better for accountants, right?
That's right. So I like aging better.
So let's talk through percentage of credit sales as a first example here. Your goal with the percentage of credit sales method is to estimate the bad debt expense on the income statement. So when you're using this credit sales method, you're trying to get your income statement right for that period. You're going to guess what the bad debt expense is. And the way you're going to do that is take what are your credit sales for the given period, not total sales, but what are your credit sales, and multiply it by a given percentage. And I say given here because it's going to be given to you in your problems. If you're actually working for a company, you're going to look at historically what percentage of credit sales have we not collected on, and you're going to use that historical percentage adjusted based on the current situation. So just as an example here, let's say credit sales for the period were $1,000 and historically 2% were uncollectible. So Boz, you like this one. What's the amount and entry for bad debt expense?
Well, $1,000 times 2% is $20. So that's the amount of the sales we don't think we're going to collect.
I panicked. I'm glad you did the math.
That's good. So debit, bad debt expense, credit, the allowance for doubtful accounts, each of those for $20. So, and again, yeah, to kind of wrap this one up, this is more of an income statement approach to estimating bad debts, which is different than the balance sheet approach.
Oh, we should have said that in sync. I was wanted to link, see $20 here is focusing on bad debt expense. On this balance sheet approach, agent of accounts receivable method, that's what we're gonna focus on, right? Estimate the amount of accounts receivable. So what should we really show for net accounts receivable on our balance sheet? That is the key, that is our goal. So 4 steps. I think I should patent this process.
You could try.
Okay.
I have an IP lawyer who's a friend. I'll ask him.
Great. Step one, you're going to take your total accounts receivable and break it apart based on the age of the receivable. So some will be current, they don't owe you yet. Some will be past due, 1 to 30 days. Some will be 31 to 60, so on and so forth until you get so old that you say, 61 plus, just over that. Step two, then, you have all your receivable broken apart into buckets. So you're going to assign an uncollectible percentage to each. So very similar, we're using a percentage, but each bucket is going to have its own different percentage. And usually as the days get older, you have a higher percentage that you're not going to collect. Example here, in our current bucket, we could have a 1% uncollectible, 1 to 30, we could have 5%, all the way on up to our last
Company's
one.
just using its experience to come up with the uncollectible rates.
Exactly. And then step three, what is the balance in each bucket? So we figured that out in step one, multiply by a percentage in step two, and then add it all together. That is our ending allowance for doubtful accounts. Now I see a lot of mistakes with this where people take that and they use that ending allowance method in their journal entry.
As a journal entry, yep.
Which is why we have step four, which is the idea of taking your beginning balance in the allowance, comparing it to what you want it to be in the ending, and then just making a journal entry for the difference
It's
between
like
the
your
two.
supplies inventory.
It'll become a little bit more clear when we go through the example.
All right. Let's do this example. We have accounts receivable of $1,000, and the first step is to break it apart.
Buckets.
Into buckets.
Yeah. You got 5 buckets here. Current, up to a month past due, basically up to 2 months past due, up to 3 months past due, and over 3 months past due. Most of your receivables are going to be current. That's a good sign because
That is definitely what you want. Yes.
Yep, because it's good that people haven't owed you money for a long period of time. So you got it in the buckets.
There you go. So now we're into step two, which is going to be assigning an uncollectible percentage to each bucket. This isn't really that cool of a slide because we're just giving you the percentages, but if you were an accountant, you'd spend a lot of time figuring out in each bucket historically what percentage has been uncollectible in the past.
And as you note, the older that the receivable is, the less likely we are to collect it. And while is just an example that we made up, that's very real as well, that when the receivables get old, you don't have a good chance of collecting them. I think about it, back in college, someone bet me on a sports game, and I haven't got paid for it yet. I actually have forgotten who it was.
There's
but I won
statute
the bet.
limitations. I think sports betting's illegal.
Anyway, I didn't bet. That was just a joke.
That's great.
We're in Nevada at the time, right?
No legal liability here. So,
right.
yeah, good answer. You're in Nevada. Step three now, we have our buckets and our percentages. So all we have to do is multiply each bucket by the percentage. So 700 times 1%, 100 times 8%, 10 times 20%. Boom, that's where we get this third line here, the uncollectible amount within each bucket.
Yeah. So basically, after we do all that, $28.50 is the amount of our $1,000 receivable which we feel we are not going to collect. But we don't just debit bad debt expense and credit the allowance for that amount. We have to do one more thing. Step four.
Step four. Boom, adjusting the allowance for doubtful accounts. All right, so in this part, we just made up a number arbitrary here. The ending balance is $20 right now in the allowance, and we want it to be $28.50. So, like we see, balance, $20. Good animation, Boz. He put this one in.
Thank you.
Desired ending balance is $28.50. So what's the difference between those two, math wizard?
$8.50, and that's what we need to do the debit to bad debt expense and the credit to the allowance for doubtful accounts.
You nailed it. You should be an accounting professor.
I'll think about that someday. I might apply. But,
all right. So this AG method does have a few more steps, but most companies are going to use this one.
Yeah, and just putting it back to a point there of this $20. It's like, why was there an amount in this account? Well, I mean, companies that are years old. I mean, every single month they'll be estimating bad debts, doing a debit to bad debt expense, crediting the allowance for doubtful accounts, and then every single month they'll probably be writing off some bad debts too, which end up as a debit in that uncollectible account. So I mean, they got all sorts of stuff going through that account. So this balance is you're never going to know what it is, but you just, where's the balance at? What do you want the balance to be? Make an adjustment for the difference.
Yeah, there'll be entire departments at companies that really just focus on collections and knowing each individual customer and the likelihood they're going to get paid. So it can get a little bit more specific even than what we're doing here, and it does actually.
And this is a rare account that the balance could be negative before the adjustment if you've actually had write-offs that have exceeded what you've estimated thus far. So this is a rare account that can actually be negative from time to time.
Cool. All right, so let's do some key takeaways and finish up here. First thing, companies are going to go ahead and track returns, discounts, different types of discounts using contra revenue accounts to better help them with their own analysis. And so you know how to set up those accounts, you know how to record things in those accounts. We're not just going to back out sales because we want to analyze everything to make sure we're not giving out too many discounts or who's taking advantage, things like that. And then takeaway number 2, we learned how to make an estimate each period to figure out or to get really a better number for our accounts receivable, looking at what should the allowance be, what should the bad debt expense be, matching those expenses to the revenues. And we talked about a couple of ways to make that estimate.
Exactly. So I think that's all we've got for today. So they're going to have to come back next time.
All right. We'll talk more next week about the allowance method rather than the direct write-off method. But any questions so far on content? A lot of that was a review on the receivables, the sales discounts, the returns and allowances, terms, free on board. But we're going to be getting much more into this allowance method of proper matching because receivables can be pretty significant when we're actually looking at things. Any comments or questions? Then I'm going to go ahead and continue onward. And we're going to take a look at Excel and a couple of things and features and functions that go with that.
Hello, everybody, and welcome to the Ben and Boz Microsoft Excel video tutorial series. We are up to lesson 5. I'm Boz.
I'm Ben.
What's going on, man?
Well, one, it's a beautiful day in Collegeville. Two, do you ever worry about that intro being like so long that you're gonna like confuse the words or anything?
I'm pretty sure that I confuse myself and everyone listening, so they're just like, I'm not sure what he's saying. Just get to it.
I think you do a great job with it.
I appreciate the support, man.
But
Appreciate it.
with that sentiment of just get to it, let's just get to it.
All right.
2 big goals today: navigational ability on large spreadsheets. This is huge, especially when you have hundreds of thousands of rows or columns of data, and learning basic data analysis. Emphasis on basic here. We just want to open your eyes to what's out there, and hopefully your
In
curiosity.
the
will
chat,
take it
can
away.
you please
And some
type
of the
in,
specific things?
have you
as
ever
see there,
used
we're
a
gonna show you how
pivot
to
table?
fly around the worksheet
Yes or
using
no?
the control shortcut, the home shortcut. We're gonna
Pivot
show you how to
tables,
use
yes or
simple
no? Have you ever
analysis
used a
with
pivot
average,
table?
max, median, and min formulas. We're going to show you how to use a very powerful tool.
2
in pivot
answers. I'm
tables
looking
and
for
how
a
to
few
present your
more.
results very
Thank you.
quickly and very visually appealing using a graph.
Hey, that's what it takes to stand out.
Absolutely.
Create convincing
recent.
arguments. All right,
That's
let's
cool.
move over to our completely real sales listing from July.
Completely real.
Completely real.
All right.
Doesn't this look like a huge data set?
Well, I
Hoping there
can't
are
tell
more
because
of
it
you
only
on.
goes
There
for
we
about
go.
14 rows. I'm kind of curious. How
Everyone
can we
should be
find out how big
responding.
the data set is?
Well, I'm doing the down arrow key. Just over and over again. That'd probably work, right?
You know, it probably will because I think you just have a few dozen rows, but imagine that you had hundreds of thousands or something like that. We'd be down
Control
arrowing for a
arrows,
long
great,
time.
great
Yeah, so
tool.
if you want to take a little shortcut, hit the control key and then the down arrow. So I'm holding the control key, down arrow, takes me to the last row, 98. You can see if I go down from that, there isn't anything more. So I'm already at the last row.
Fly around your data with the control and the arrow keys. You can go left, right, up, down, right?
Control left, control right takes me all the way to the right. Control up takes me to the very top. Again to the left to get to A1. Just 4 corners, man. Just playing 4
Moving
corners
around.
with your data.
Yeah,
Good
and
to
if you
do.
have a keyboard that has an end key on it, I think the one Ben's doesn't have it work the same way, but I have an end key on my keyboard. You can fly around also just by pressing end. You don't have to hold it down and then pressing one of the arrow keys. That works just kind of as quickly, but just helps you fly around your data.
Yeah, and in this one, if you hit control, function, and end, it'll work that way, take you to the very end. But it's a little clunky, so usually I'll just do the control and arrow keys.
Sure.
Boz, how many rows do you think there are in Excel? We're at 98 right now. I'm gonna do control
Well, this
arrow
is-
key
this
all
is
the way
something
down.
that I should know, right? Is it a few 100,000? I'm trying to remember.
It's over 1 million now. So I would do
Okay.
control down arrow key. There's no more data, so it jumps to the very end. 1,048,570. Little piece of trivia for you.
Well, and I'm glad you did this because once in a while people accidentally bump this and then they're all down and they're like, oh gosh, how do I get back up to the top? And then what most people probably do would be take their mouse, go over to the far right, find, what do I call that, the cursor or the drag or whatever it is, and just kind of drag it all the way up, which is fine. It's no big deal, right? But there's a quicker way to do it.
There is a quicker way to do it, which is one of our next ones that we want to do. So if we want to go to A1, the very beginning, what we need to do is hit control and home key. And again, on my keyboard, I have to hit control function and home key. It's just really the size of the keyboard. If you don't have that function button or home is its own, then probably control and home would do it. But for me, control, function, and home, and it takes me right back to A1.
I use this
Ready
one a
to
lot
go?
with big data sets. I'm just somewhere way down, I'm way off to the right. I want to get back to A1, control home, and I'm done.
Perfect.
What if maybe this is what you're about to say. Let's just say that you were over in column H or, okay. let's
How
say
about
you're
column
right.
XFD?
And what I was going to say, let's say you don't necessarily want to get to A1, you know what I mean? But let's say in this situation,
I want to be at A12.
yeah, you want to stay in the same row, but get back to the first column. How would you do that then?
Perfect. So this one, you have to use that home key to get you to the first column. So I'm going to hit control and function and home. Because again, I don't have that separate home key. And that took me to A1. If I go back,
I think you just don't need the control, right? Just function home. Would that have
function and
gotten
home, there you go,
Yep,
perfect.
yep.
Yep, function and home is going to get me right back to A1.
On my keyboard,
Or
it's just home, so I'm way off to the right, and I want to go. Maybe I want to go to the start of that of that row, so I can see some preliminary information there. But I don't want to go all the way back up to the top of my spreadsheet. I just go home, and it takes me right back to column A.
Perfect.
Use them a lot.
There we go.
Mm-hmm.
All right, so let's start by just getting a little bit of information about this data set. Some sales data. We have invoice numbers, different customers, the amounts of each invoice, the date, and the due date.
We're gonna do some data analysis.
Little data analysis.
Yes.
So just a good general beginning point when you have a data set is to just get a sense of the scope. Is it going to be, what's the average, max, median, minimum, things like that. So we'll start out with average.
You
This
do
is a sales
research,
table.
you
We're
do
just
that.
trying to
That's
figure
a
out what is the
basic
average
analysis
dollar amount that
every
we sell
time.
to a customer.
Is this
As an
our
example on a
first-
single invoice?
Is this our first function here that's not like a plus, minus, multiply, divide?
I think so.
I think this is groundbreaking. So Excel has a whole bunch of functions built in. You don't have to do equals the sum of all of these divided by however many there are. That would take way too much time. Instead, Excel has average just built in. So you hit the equals button, start typing average or spelling average. So I do AV, and now you can see, well, here are just 5 functions in Excel that start with AV. And I want to do average. You could click on it with your mouse. Never do that. Forget you have a mouse for right now. Instead, I like to use the arrow key. to navigate to decide which function I want to use. In this case, it's average. And once I have it, I hit the tab key. And that automatically puts it in, opens the parentheses for me. I don't have to finish typing average, and I'm ready to go.
Yeah, now it's basically saying, what do you want to average? That's what it's asking you to do next.
Yeah, and so you see where it says number 1, comma, number 2, comma. What that means is I could click on the first one, 3,922, then hit a comma, and 1,865. You see it moved over to number 2 right there, and hit the comma. Now it wants the third number. Well, that would take forever with a large data set. So
But the only time I would do that is if I only had 2 things that I wanted to average, and I thought they might change, right? So then I would just build that formula in there so that would constantly update, but that's usually not the case.
yeah, usually what I do with average is once I get to this point, I click on, so if they're all in the same column, say C, I'll click on C, and then now it's averaging everything that's in C. I can close my parentheses, hit enter, and there we go. I have my average.
What's nice about that, I was wondering how that was going to work. I think your way is a little better. I would have got nervous because of that header in there. I wasn't sure if the header would mess stuff up, but Excel's really smart. It ignored it. It says, hey, it's not a number. I can't average it, so I'm just going to ignore it.
So another way you can do it, we'll show them on the max formula. How about that?
Sure.
If you do equals in this one, I feel like Excel was created by a bunch of accountants because they're not super creative with the names. If you want to know the max invoice amount, it's going to be equals max. And you can see there's match, max, a whole bunch of different ones. We're going to do max.
And I usually, with something
You
that
like
short,
Mad Max?
honestly, I would just type in equals max, open parentheses. That's me, at least, just because it's so short as compared to going through that drop-down list. But either way gets it done.
Yeah. For usually what I end up doing is the most number of, or however many letters I need, so I just have to do a couple arrows down
Yeah,
to get it.
yeah.
So there's max, and then I'm gonna just navigate, instead of clicking on C, that would work again. I'm gonna navigate with the arrow keys over to the first one, 3,922, hold the control and shift key to highlight it, hit the down arrow, so control shift and down arrow. That's everything that I want highlighted. All I have to do, I don't even have to close the parentheses. I can just hit enter. It automatically closes the parentheses for me. And you can see the largest invoice amount was $4,961.
And just to show how those constantly update in cell C2, why don't you just go ahead and type $10,000 in there or something like that, and we'll just see how that.
10,987.
He just has to do something different. I love it.
Hey, look at that.
Automatically updated.
And did you see the average updated as well?
Yeah,
It was
yeah.
2,470.
Very cool.
Control Y to redo that, and it's 2,543.
So as you look at those, certainly what Ben did first, just highlighting that whole column, was quicker, but you don't always want to do the function with the whole column because you might have multiple sets of data within a column. So that's why we wanted to show you how you would just select a set of data, what Ben did with the max that way.
All right, so median, Boz, you want to take a shot at that one?
Well, if it's me, because I usually just type in the equals, I do type in equals median, open parentheses.
But look, see, I just did ME there,
Yeah, yeah.
and if I hit tab,
Yeah.
that saves me DIAN and open parentheses.
It does.
I'm just counting up those seconds. I'm saving in my life right
We
here.
we are. So you got to get it alive now. You got the open parentheses, and if you just want to click on the C, because we're trying to do the whole data set here, just click on the C and then close parentheses and then enter, and we're good.
Perfect. And then one last way I want to show you how to do this is with the formula builder. And so we've been taking more of like a shorter direct route because once you get into Excel, that's really what we want you to know and how to use it. But let's go into minimum here. Don't forget to hit the equal sign first. Equals minimum is going to be equals min. And I'll hit the tab to select it. But once I have it, I can click on this little f of x here. It's an insert function, our function key. And it brings up the arguments for me. So min, it gives me a little description, right? Returns the smallest number in a set of values, ignores logical values in text. And that's why C works, right? Because it's ignoring the text, which is the amount. And so it tells me, hey, here's how you can do it. And then I could click number 1 and click that, and then number 2 and click that, and number 3 and click it, right? And so it's all updating. And of course, you're not going to do that because that takes way too much time.
You wouldn't do it with this one, but some functions, it works out pretty nicely on this one, especially ones that are less intuitive. We'll have some of those coming later in our series, so hopefully everyone watches all 12 videos. But if you just stumbled on this one, we just wanted to make you aware of kind of that really nice function pop-up window.
Yeah, and so for number 1 here, you can just click on C, and it puts in all of C. That's all you need for your input, because that's all we want to find the minimum of. Hit OK,
Nice.
and there we go, 127.
Nice. Yep, some very quick data
Boom,
analysis. Yeah.
nailed it.
Yep.
You ready to take the next step in data analysis?
Well, and the next one is one of the most cool features. We've been using it a long time, but I mean, it is just
It's
extremely
just
cool.
powerful.
Possibilities are endless when it comes to pivot tables.
Yeah.
So to do a pivot table, you're going to click anywhere in your data set that you want. And so I just click randomly B5, that's fine. And then you're probably on the home tab to start. If you go to insert in the insert ribbon, in the tables section, there's pivot tables.
Yes.
And so you click pivot tables and it says select a table or range. Well, I know my listing is A1 to E98. If I didn't like that, I can always click outside, click on A1, control shift over, control shift down. Hey, look at that, A1 to E98. It's right there, right? It's
Almost
ready to
always
go.
it pulls up what I want. And part of that, before you get to the pivot table, you got to make sure you have good data. So I clean up my data, and we're working with a cleaned up data set to begin with here. I clean it up, make sure there's not any extra spaces or something like that in there. So by the time I get there, it's going to work for me.
Exactly, and it's always good just to double check, make
Yeah.
sure you're not pulling in something you shouldn't.
Sure.
Then down here, I usually go to a new worksheet for a new pivot table, so we'll leave that. If you wanted to put it in the existing, you could, and then just pick your cell. So maybe this cell is where we want it to go, but we're going to go with a new worksheet instead, and then hit OK. And look at that.
That's not very impressive.
Look at that.
There's nothing to look at, just some weird thing. Why
What
am
would
I
be
supposed to
something cool
impressed?
to know about our data? You're a business owner. You have that sales data. What's something you might want to know?
Which customer do we sell to the most? So
All
you've got
right,
a variety of
customer
customers.
information. Because you saw in our original data set that we had,
I found
it was,
go ahead,
it was
sorry.
just all set with so many
Yeah.
different customers. And so what we can do in a pivot table is summarize, automatically sum, how much did we sell to each customer?
Because then what we did with that max, we found the biggest sale period in that previous sheet, right? But we don't know what customer we sell to at the highest amount when we include all sales.
Well, if you want to hold your breath. All right, we're gonna sit here in silence for 10 minutes and then figure it out. No, all right, so if we take customer number, drag it to rows, it doesn't have to be rows. If you wanted to, it could be columns, right? So each customer had their own column.
Yeah, rows would work better here, but it's, just play with it.
Yeah, that's basically it with pivot tables. You just play with the data until you get something that looks kind of cool. So
Sandbox.
we have our customer numbers, each customer there, and we want to figure out the amount. And I'm going to click and drag it into the sum of values. You don't have to do it that way. You can check the box. It'll try and guess which one you want. But I will do the sum of
I
values.
usually drag it too, yeah.
Yep, and it defaults to sum. So what I can see now, if I look through this listing, that customer 105 had the most, 36,164.
This is the
No,
precursor
what
to
if you had 100
Tableau, the
customers? Are you
next
still
step.
just going to kind of eyeball that? You might get it wrong.
You know, you might get it wrong. What you could do is sort it highest to lowest. There's a whole bunch of different ways that you can do this one. You could right click
I
as
can
an
just right
example.
click right within my data.
And sort
just like we
largest
did.
to smallest if you
Boom, we
wanted
got
to,
it.
that would work.
Yeah.
Otherwise, up here, sort and filter. You can click on this, smallest to largest, largest to smallest on your
Yep.
home tab. A bunch of different ways to do it.
We can throw some commas in there. It's tough for me to look at that thing.
You getting a
Ben.
little stressed out right
Yeah,
now?
I might want some commas.
All right, so I'm in my data, just Control, Shift, and down to highlight all of it. Click on the commas. And as much as you like the commas, the decimals actually stress me out. So I'm going to go ahead and get rid of that. It adds no value anyway.
Yeah.
So now we have something, okay, a little bit useful here.
Yep.
One thing cool, like I said, it defaults to the sum. If we want to, we can go to our sum of values here, click on the little drop down, and on value field settings, we can do a count. So maybe I can see for each customer how many sales they did. Notice these customers changed. It's still sorted highest to lowest. So 101 had the most frequent number of sales, right? I had 14 invoices with 101.
Yep. So we basically looked at that one as far as which customers did we sell to the most times, not the highest dollar amount. But that just might be something you want to know.
But average amount might be interesting to know too. So if you don't want to navigate all the way over here and click on this drop down, just within your data, right click, and you can see summarize values by sum, count, average, max, min, product. There's even more options. We're just going to stick with some of the basics right now for average. And now you can see the highest average was also 105. Not only the highest total, but the highest average too.
It'd be nice, this is pretty good information, but you walk in, you hand that to a manager, and that might just be a lot of numbers for them to look at. It'd be nice just to make this more visually appealing, frankly.
I would love that. Uh-oh. I clicked off of my pivot table. What do I do now? Where's all these things that I wanted to click and drag? What do I do with it?
I think, are they gone permanently?
No, all you gotta do
They're
is
right
click
there.
right back in there. It's right back. In case you made a mistake, just drag it out, move it off. It's gone.
That's
right?
how you get them out of the pivot table. You just drag them into the data.
Click and
basically.
drag. Literally, you're not going to break it. It's really easy to put it back together. Just kind of
Yes.
experiment with stuff. So back to what you were saying, Boz. It
Sorry,
is-
I jumped the gun a little bit. I
No,
tried to
that was
predict that
good.
you were done, but I
No,
jumped
it was good. The thing we want to teach now, though, is how to enter in a graph pretty easily. And again, Excel is smart. It's a smart tool. So if we go to Insert, and remember, I'm just clicked in my data right here. I'm going to go under the Insert ribbon, Charts. And I like using recommended charts. Do you use recommended charts?
Yep, usually. It's because it's smart. It brings up the most common usually.
There you go. So I could put this in column format or line format. I could put it as a pie chart. If they have a lot higher average, they take up a bigger slice of the pie. As a scatter plot, I guess wouldn't really work with this one. An
this is a
area
good-
chart, that might, give it a little heft.
It really just depends on the data, how it's best presented. Column charts for something like this are probably where you want to be.
I agree with that 100%. I would do a column chart for this one, hit OK, and it automatically pops up. I can move it wherever I want in Excel. Average of amount with the total. You see, I got my little
Going
customer
down.
numbers. I can filter this for certain ones. Maybe I only want to show customers 100, 102, 104, and 106. And then
Nice.
you can see it's just those four. And there you go. I can just focus on that. If I want to clear the filter, I can click on it, clear the filter, back to normal.
What if
and
I
we're all
wanted
set.
to reorder by customer number instead? So not like who has the highest average sale, but I actually just wanted to show customer 100 first and so forth.
Yeah, so for what I would do is go back to the data,
Yeah.
that one, and then I would right click in the data, and then where it says sort, smallest to largest, 100 to 110. You can see my table is now 100 to
Chart
110.
just updates in
It's
real
pretty
time.
slick, isn't it?
It's awesome.
I actually like how it took a second to show me things were moving. That make me feel like something was happening.
That's actually a good point. So you know something's happening. It's like, did something just happen?
All right, well, should we do a little summary here?
I think
Make
you
sure we
did it all,
covered
yeah.
everything?
I think we did.
All right, hopefully you know how to navigate a little bit better around the text using the control, the home, and perhaps the function key if you need that. You got your introduction into how to do some of the formulas that Excel has, like average, max, median, and min, and you've opened your eyes to the wide world of pivot tables and graphs in Excel.
All right, thanks everybody for tuning in to Lesson 5 here in the Ben and Boz Microsoft Excel video tutorial series. Tune in next time in Lesson 6, a sneak peek.
Okay, so there we go. Got a flavor of receivables, got a flavor of Excel. some powerful functions, just maneuvering around, and those pivot tables are good as gold. And your employers are going to be expecting you to have familiarity with moving around, creating formulas, and ideally pivot tables will be where you end up getting to. Any questions before I wish you a good weekend? Then enjoy. Thank you. Look forward to seeing you on Monday, if not sooner. Have a good one.
Have a good weekend.
You too. Thank you.